Howdy, you're watching Aardvark Tax TV. I'm Sean Kenefick. I'm an enrolled agent and customer service representative here at Aardvark Tax. This video is part of a complete continuing education course available at our website, www.aardvarktax.com. Today we're going to talk about depreciation. Depreciation is a method we use to deduct the expenses incurred when we bought certain business property. It's different from a standard expense, though, in that with expenses, we take the entire amount in the year in which we incurred the cost. With depreciation, we spread that deduction over a period of years, typically what we would consider the useful life of the object. Depreciation has two rules associated with it. The first is that it's for a property that we use in business or to generate income, so it also applies to passive activities such as rental property. Second, any object that we purchase that's going to be depreciated has to have a useful life of over 1 year. Typically, you will find that objects that have less than 1 year of useful business life do not need to be depreciated. We start depreciating when we place that object in service or make it available to our business. So that doesn't necessarily mean that we have to use the object immediately. It just means we've made it available for our business. Examples here might be that I bought a rental property and I have not had any tenants yet. Even though I don't have tenants in the building, the fact that I made it available for rent means it's been placed in service. Another example might be that I'm opening a store, and a month before the store opens, I buy a computer that I'm going to use as a cash register. Even though I'm not using that computer as a cash register immediately, I've made it available to my business, so therefore I can place it in service the day I made it available. Each of these objects that we have has what we call a basis. That's the cost that we paid for it, plus any associated fees that we might have had concerning it. So, for instance, if we buy real estate, we paid a certain amount for the land and the improvements, but we also paid some other things like transfer taxes and title exchanges that added cost to the entire amount we paid. All of that together is considered the basis of the product. As we depreciate those objects over time, we subtract that depreciation from the amount that we originally considered its basis, and that becomes its adjusted basis. This is important because when we dispose of the property, especially if we sell it, what the IRS would consider our gain is based upon our adjusted basis rather than our basis. Another thing to think about with basis is that your basis is going to be different depending on how you acquired the object. For instance, if you bought the object for your business, it will be the cost you paid plus any associated fees. However, if you inherited the property or it was gifted to you from someone else, that basis is going to be different. If it's gifted, you are going to have a basis that is the original basis of the person who gifted it to you. If you've inherited it, it's going to become the fair market value of the object on the day that the person died that you're inheriting it from. So there are different rules there. Another aspect of depreciation and adjusted basis that's important is that depreciation is considered to have occurred even if you don't take it on your tax return. If your object was able to be depreciated and you chose not to for whatever reason, including ignorance, then your adjusted basis still is considered the amount if the depreciation had occurred. So it's very important that if you have depreciation abilities given to you, that you take it. Another thing that's important about depreciation in general is that tangible and intangible objects are treated differently. Now, tangible object is something you can see or touch, like a car or a computer. Intangible property are things that we as a society agree exist even though they don't exist in the real world. These would be things like copyrights and trademarks. Because these things are treated differently by the depreciation rules, it's important to understand the difference between them. First, let's talk about how we depreciate tangible business property. For that, we use the Modified Accelerated Cost Recovery System, or MACRS. That's been in place since the Tax Reform Act of 1986. Before that, we used a system called ACRS, or the Accelerated Cost Recovery System. That was in place from 1981 to 1986. So both makers and acres allow you to take the bulk of your depreciation in earlier years rather than spreading it out evenly throughout the useful life of the product. The spreading it out evenly was called a straight line, and we did that before 1981, and still in some cases we do that today. Property classes in makers are based upon the useful life of the objects, or another word for that is recovery times. Let's talk about them in a little more detail now. 3-year property has a recovery time of 3 years. Some examples include tractor units for over-the-road use, racehorses that are over 2 years old, and breeding hogs. 5-year property has a recovery life of 5 years. It includes automobiles, taxis, buses and trucks, computers and peripheral equipment, office machinery, breeding cattle and dairy cattle, carpet, appliances, furniture, and other things used in residential rental property. Use the 7-year property life for office furniture and fixtures, agricultural machinery and equipment, or any other property that does not have a class life and that has not been designated by law as being in any other class. 10-year property includes things like vessels, barges, tugs, and similar water transportation equipment, any single-purpose agricultural structures, or any tree or vine that bears fruit or nuts. 15-year property includes certain improvements made directly to land, such as shrubbery, fences, sidewalks, roads, and bridges. It also includes qualified leasehold improvement property placed in service before January 1st, 2011, and any qualified restaurant property placed in service before January 1st, 2011. 25-year property is the class used for water utility properties such as sewer systems and water treatment centers. We use 27.5 years as a recovery time for residential rental property. This class includes real property such as rental home or structures if 80% or more of its gross rental income for the tax year is from dwelling units. Non-residential business real property has 2 different lives depending on the date it was placed in service. The recovery period for non-residential real property is 39 years for property placed in service after May 12, 1993, or 31.5 years for property placed in service before May 13, 1993. There are 3 conventions we use to figure maker's depreciation, and the IRS provides tables for those conventions that show exactly what percentage of depreciation to take for each kind of property in certain years. The half-year convention is used for property with recovery times between 3 and 20 years, so that obviously doesn't include either residential or non-residential business real estate property. The mid-quarter convention is used in the special case where you have placed the bulk of your property in service at the end of the year or during the last quarter of the year. This was used to close a loophole where people paid less tax by placing things in service at the end of the year. The third convention is called the mid-month convention, and we use that as our convention for both residential and non-residential business real estate property. A subset of depreciable property is subject to special rules. These assets, called listed property, have rules that limit the amount and type of depreciation that can be taken if they aren't predominantly used for business. Listed property types generally include assets where there might be some confusion on whether they are used for personal or business use. There are 3 major types of listed property. The first includes passenger automobiles and vans, unless they are clearly marked as police, firefighting, or ambulances. The second is any property type that is generally used for entertainment, recreation, or amusement purposes, such as cameras, video cameras, cell phones, and televisions. The third type is any computer or peripheral that is not used at a regular business establishment. Keep in mind, though, that an area in a home set aside 100% use for business and declared on Form 8829 is considered a regular business establishment. If you're using these assets 100% for business, or anything over 50%, then you would depreciate them just as you always would, with makers, generally considered to be the most favorable way of depreciating assets over time. However, if you use listed property less than 50% for business, then you can no longer use makers and must instead use the straight line ADS method, which is considered a less favorable method of depreciation because you no longer front load your expense. In either case, the personal use percentage of assets cannot be depreciated. Up until this point, we've considered makers to be the most expedient way to deduct back the cost of our capital assets. In future sections, we'll discuss the special depreciation deductions that let us expense part or all of our capital assets in the year that the cost was incurred. So stay tuned. This video has been part of a tax continuing education course available at www.aardvarktax.com. The course has been approved by the IRS and state governing agencies such as California and Oregon, but just viewing the video won't get you credit with your governing agency. Be sure to register for this course or any of our other courses by going to the aardvarktax.com website, and then we'll be sure to report your successful completion after you've finished.